In this video, let's look at some live market data so you know how to enter and exit each trade. Right here, we're looking at QQQ. Again, don't worry about these expiration dates or the price or anything. It's all extremely irrelevant. I'm just going to show you how you can enter into these trades. So first, let's look at a regular naked put. So when you want to sell a put option, you find a strike price that you want. So let's look at this 15 delta. You would see it's 250 strike. Again, QQQ is trading at 280, so it's about $30 less. So you would right click and then you would hit sell to open. And remember, when you sell a contract, you always sell at the bid, which is at 285 right now. So you change this contract to 1, make sure the right expiration date, the strike price, the price, make sure it is the bid, and you hit sell to open. That's how you enter into that. And the difference between this and a cash secured put, again, is naked puts use a margin account. So right now I'm looking at my Roth IRA, so I obviously don't have margin enabled here, but if you have a taxable brokerage account, you can get a margin account and you could actually get into this trade without even having $25,000 in collateral. But just know there are significant risks associated with borrowing money to sell options. So I just want to let you know that it's not necessarily advisable, but knowing that you can do it if you have a margin account. So that's the difference between a cash secured put and a naked put. Now, let's say you want to sell a naked call. You'd find a strike price that you're comfortable with. I mean, look at this 20 delta. Again, right click, sell to open on the call side. Again, change the contract to 1, go to the price, make sure it's a bid, and you hit sell to open. Again, the difference between doing a naked call versus a covered call, which you've been doing. With the covered call, if the stock goes from 280 to 350, you don't have to buy the stock at 350 and sell it back at 305. So this is different than the covered call, because a covered call, you would own 100 shares. So if the stock goes from 280 to 350, you would have to sell the stock at 305. But if you sold a naked call, if the stock goes from 280 to 350, you would have to buy the stock at 350 and sell it back at 305. And so you would take a $45 loss per share. And remember, each contract is for 100 shares. So that's $4,500 of loss if you do a naked call. So just letting you know, there are a lot of risks associated with naked calls. That's why I taught the covered call first. So now let's say you don't want to own the stock and you just want to collect income, right? And that's where spreads come in. So let's look at this 15 delta put credit spread. Again, you right click, you click sell to open. Here on E-Trade, there's actually something that says spreads. So you click that and you type in QQQ, you would sell to open one contract. And here you type in put the expiration, we're looking at January 20th. And then the strike, what do we have over here? The strike, we had the 250 for the short put, and then a little bit below 248 for the long put. Now, when you do this, you could see that it's actually gonna get lumped into a single position, and the net credit is 0.24, as you're making $24. So you're putting up $200, the 250 minus 248, the width of the strikes, and you're collecting 24. And I guess I have about 200 bucks or so in my Roth IRA right now. So I'm going to go ahead and actually enter into this position, right? So I paid dollar in commissions. So you got the 250, 248 put. So I'm risking $200 to make $22. So it's about 10% or so. I'm going to enter into an iron condor next and I'll show you. So here I hit place trade. And there we go, I got filled. So that was the put credit spread. Now let's move on to the call credit spread. I mean, look at the 310 strike, sell to open. Again, I want to do a spread. I need to change this to calls and the dates are good. I want to do the 310 and the 312. And when I do this, you notice how I would get 27 cents or so in credit. So I hit submit and you'll notice that the estimated proceeds are about 26 bucks. I hit place trade. And there we go. I got filled on that as well. So you could do it as 2 individual trades, 2 credit spreads, or you could do it as 1 iron condor, which is again, combining the credit spreads. Since I just entered into it, I'm not going to do this, but let me show you what we could have done. So you want to buy to open the 248, and then you want to sell to open the 250. And similarly on the call side, you want to sell to open 310, and then we would buy to open the 312's protection. So it comes out to about similar amounts. I mean, the net credit's between 51 and 59 based on how the market fills you, but you can do this in a single trade like this, or you can do it as 2 individual spreads. So I'm not going to submit this because I just entered into 2 spreads that had this exact position. I gotta tell you, it's exhausting placing a trade like this on E-Trade's platform on the computer. I almost never trade on the computer. I'm using it purely for this course's purposes, but it's very simple on your phone where you can just click the actual buttons and it will basically do it for you. And phone, it's a lot easier trading on your phone. I don't want you to get scared thinking that this is going to take a lot of time, and it's actually a lot easier than it looks on the cell phone. Great, now let's look at just a few more trades and then we'll be done with this video. So we talked about the naked put, naked call, the put credit spread, call credit spread, iron condor. Now last, let's just look at a straddle. So right now, again, QQQ is around 280, 282. So you could right click here, and when you sell to open, notice here I switched to individual brokerage account. Now options level is 4 here, but I don't have any capital in this account. But you'll notice that if I were to sell one contract on just the call side, I would collect $1,100. Now, if I were to sell the same one over here, the 282, I would collect another $1,100, almost $1,200. So I'd make between $2,200 to $2,300 if I were to enter into this trade right now. So that way, if the stock stays plus or minus $20 from this range, the 282, on January 20th, I would basically be profitable. So again, a straddle is an undefined risk trade. So you could technically lose a lot of money, but there are certain instances to use it, which we'll talk about later in this course. And that is the end of this video. I'd recommend you guys to try this on your phone. It will be a lot easier. And if you guys have any questions, just let me know. I'll see you in the next video.